Hi, I'm Max and I'm one of the mortgage brokers from Golden Eggs Home Loans, where we love to help educate and guide you to buy and hold more property over the long run. Now let's look at the 3 ways of offering a security guarantee. The first one is that you offer up the whole property. Now we're going to look at some pictures here. Now the property that we're going to look at here is, let's say you've got a property that's worth $1 million. And let's say your kids want to buy a property that's worth, say, $600,000. Now in that case, let's say, for example, the people are buying a property, and we're going to call them the kids. They've got enough money to cover the stamp duty and other costs, but they'd like to borrow $600,000. Now, the bank obviously doesn't want to give them a 100% loan, so they simply take 2 properties as security. In this case, you've got your property and their property are both on the loan. Now, this is called an unlimited guarantee. The problem with this is, because it's unlimited, should the market go into turmoil, and let's say disaster scenario, unemployment rises astronomically, everyone's struggling to pay their mortgages, and property prices suddenly fall off a cliff. And all of a sudden that $600,000 property, which they're not making the payments on, is only worth $400,000. Now in that case, the bank has the right to chase you. Firstly, they've got a right to sell the original property, but they try and sell it to get their $600,000 back, and they only get $400,000 for it. So now they're $200,000 short. And because you signed an unlimited guarantee, the bank can chase you for the whole amount. And if you can't pay that $200,000 that is owing, then they have the right to sell your home or whichever security you've offered to get their money back. Now that's the biggest risk with any type of security guarantee, that the bank has the right to sell your property in the event of a default. Now, defaults are something that don't just happen because somebody misses a payment. You miss 1 payment, you get a letter. You miss 2 payments, you get another letter. You miss 3 payments, and it starts to get more serious. Banks in Australia report 90-day arrears to their shareholders. And so you go into their kind of watch list, and suddenly you start getting solicitors' letters. But it still typically takes 6 or 12 months before a property can be repossessed and sold to enforce the mortgage. It's going to take some time, unlike a servicing guarantor where 1 payment missed and you'd be getting a letter. But in the doomsday scenario, then the risk you're up for is actually unlimited, or in our example, $200,000. So most banks will do it one of the other 2 ways. Now the second way is similar to the first way, but it's called a limited guarantee. Now in this case, really, the bank says that they've got a $600,000 loan, and the security they need for that is $750,000. Now, the reason it's $750 is because 80% of $750 is $600. Now, obviously, if the kids are supplying $600,000 worth of property, then you need to provide a limited guarantee for the balance. So in this case, your guarantee is now limited to $150,000. So in the example I gave before, where the property market crashes, you're only out for the $150,000, and the bank can't chase you for $200,000. They've got to come and get the balance, the $50,000 from the kids, and the kids have got to sell their assets or whatever to try and get their money back. So a limited guarantee is obviously a better way than an unlimited guarantee. But there's a third way, which is actually my preferred way of doing things, which is what we call a split loan. Now in the split loan scenario, it works differently, because now what we're going to do is say, look, your kids are buying a property for $600,000. The banks want to lend them 80%, which is $480,000. So if the kids borrows $480,000 in their own names, then that's what the first loan is, in their own names using their property. Then we have a second loan, because the second loan needs to make up the difference of $120,000. And that second loan of $120,000 is secured by both properties. Now the second loan is still in the kids' names, but it's now using the 2 properties. Again, looking at the doomsday scenario where the economy's collapsed and no one's got any jobs anymore, you've only signed up as a guarantor for $120,000 instead of $150,000, or an unlimited guarantee. So this is my preferred option. Firstly, because your exposure as a parent is more limited. And secondly, because now you can start to do something quite clever. And that's to say, we've got 2 separate loan applications. Because it's 2 separate loan applications, we don't have to do it the same way. So you could do the first loan as 30 years, interest only for the first 5 years, and the second loan as principal and interest for, say, 10 years. Now, in the next part, we'll talk about the rest of the risks associated with the guarantor. I'm Max Phelps from Golden Eggs Home Loans, where we like to help you grow your golden eggs.